Good morning, everybody, and to those who join us from Asia, good afternoon. I'm delighted to have Ashley Alder with me today for a full consulting discussion with. This is also the last one of the year, so it's a real honor and pleasure, Ashley, to have you with us. I think everybody who's attending will know who you are, but just to remind them, you are, of course, the Chief Executive Officer of the Hong Kong SFC, the conduct regulator, and importantly also, and congratulations again on that, the chair of IOSCO, the International Organization of Securities Regulators. Um, Today we want to look a little bit at the work program of IOSCO and also how IOSCO has responded to the COVID crisis. And maybe, Ashley, I could start with the issue of sustainable finance. It's the one issue that's keeping us very busy in Europe at the moment and has for years. But I think it's interesting to see in the work program that it's become a real big focus also of the work of your organization, and not least through the Sustainable Finance Task Force. Maybe you can kind of set out a little bit how you got to this point and where you see IOSCO's role in this debate.
Yeah, sure. And a little bit of this, I'm not really sort of speaking for IOSCO today specifically. So as the US regulators always do, there's a disclaimer. These are my own personal remarks and should not be attributed to any particular organization. But having said that, you're absolutely right. The topic of sustainable finance kind of rocketed up the agenda in IOSCO over the last 18 months or so. We have, as you mentioned, we have a task force that is led extremely well by Erik Theden, who is the chair of the Swedish regulator. I think where we're at now is that I think there'll be more done and produced and more change, not just around the EU program, which of course is seen to be ambitious, but also globally over the next few months in the run-up, in particular to COP26 in the UK next November. There'll be more done in that period, and I think that have been done in many months prior to that. I mean, the focus of the IOSCO work, around which we're going to base two reports, with actions, is, I mean, the topics are fairly familiar. First of which is that we have a particular focus on climate. And I really needn't go into the reasons why, I don't think. I think it kind of speaks for itself as to why climate is, say, at the kind of the top of the list in the sustainable finance world. Second point is that we always look at this from the perspective of securities regulators. And I say that because obviously there's been so much going on in what could I call the voluntary space around sustainable finance. But I do think that actually there's now emerging a very, very clear basic sort of regulatory framework around sustainable finance and climate in particular, and that one of those, I mean, I think there are sort of four main elements actually. One of them is, and possibly I think the most important, is something again which has been looked at by multiple organizations at multiple levels, which is corporate disclosures around climate change risk and impact on the climate by corporates. And the reason that those disclosures are so important is, of course, they're disclosures about what's happening at the real economy level. And the well-known issue with that, or problem with that, is the fact that corporates have had a menu of different sustainability disclosure frameworks to choose from, and standards. And that, of course, leads to confusion. It leads to an impaired ability on the part of investors to compare. And if you can't compare, you can't make reliable investment choices because you don't have comparable information. It's if anything, that issue from both a substantive basis and a regulatory basis is the key impediment to a pathway to mandatory disclosures. Anyway, having said that, we I think are looking very, very hard at and intending to cooperate with the IFRS proposal to set up a board that's parallel to the Accounting Standards Board, which is a sustainable finance board, initially again concentrating on climate. And the reason why I think we are keen on the IFRS proposal proceeding is that it addresses some of the points. The first of which is comparability and consistency, and that's because there's a parallel project or related project by 5 of the main standard setters in this space, such as GRI and SASB, etc., to converge their standards. So if you have an outcome whereby converged standards can be then incorporated within the IFRS framework, so that those standards become by and large uniform, there's a great advance there. And there are 2 other attributes of the IFRS system, I think, that are important, quite apart from the fact that it's global, because obviously IFRS accounting standards inform accounting standards and are accounting standards for much of the world outside the US, and in that respect, GAAP is in any event similar. So the 2 attributes, I think, are firstly that the IFRS system has an inbuilt existing very strong governance process for the production of standards, and that is overseen from a public interest perspective by something called the monitoring board. The monitoring board is chaired by an appointee from IOSCO. So the organization I chair, which is the standard setting organization of securities regulators, has a direct role. So taking advantage of that governance structure, I think, could be very, very important and is a good shortcut to the way in which those standards would interact in future with expectations and conformity at a corporate level. And the second attribute is potentially, it is only potential at the moment, is that, of course, accounting standards are subject to audit. So the question is whether or not sustainability standards, and in particular, initially sort of TCFD-based climate disclosures, could then be subject to a form of assurance which is akin to audit. Now, it's difficult because many of these standards effectively mandate disclosures of forward-looking information, using a scenario analysis approach, etc. So the type of assurance will be different, but nevertheless, we do have a framework where that may take place. So that is a development I think I'm personally very, very keen to push as hard as we can. When I say push, I mean collaborate with IFRS and the existing standard setters and such like to achieve an outcome before COP26. I was going to mention 1 or 2 other areas of sustainable finance, but that's the basic one, because even at an asset manager level, when we're expecting asset managers to strengthen their governance and encourage systemic risk management of the implications of climate change, ultimately they can only do that if they have good real economy information from the corporate sector to do that. Ditto products and similar. The only other thing I'd just say from a Hong Kong perspective, but also IOSCO, is that the need to align taxonomies is also really, really, really important. And there is good work going on there, not least between China and the EU, but also within the central bank platform, which has been set up to look at the sort of climate stress and the balance sheets of insurers and banks. But I'll leave that topic there for the moment, because I know you want to delve into other areas, but it is super important to us.
Thank you, Ashley. And by the way, just remind everybody, please do feel free to post questions on our kind of Q&A function. But maybe, I know we want to move on, but maybe allow me one or two follow-up questions, Ashley. I think it's really important, and I applaud you for the international convergence work around this area, around disclosure, and the work, putting the International Accounting Standards Board at the center of some of these developments. But if you look at it from a European perspective, and I'm kind of paraphrasing here, but from an EU perspective, the feeling is always, let's get our own house in order first. So let's agree at the European level on certain standards, practices, and then we engage with the international standard setters towards some form of an international practice. How do you feel about that? Because it's kind of, it's a bit counterintuitive to the top-down approach that I think would make sense. On the other hand, you need to first be clear about your views before you can go into an international forum to articulate your views. So how do you handle that tension? Because
yeah. Well, I mean, firstly, it's understandable. And, the sort of political and social dynamic around the European approach to green finance overall is, I think, well understood and I think broadly welcome. We often have the sort of purist sort of theoretical view that for a global problem, the first thing you do is establish a global standard and then it cascades down there to be for implementation in various jurisdictions is all very well and good in an ideal world, but we're not in an ideal world. So I think we have many other instances historically of where international standards do coalesce after different jurisdictions have been addressing the same problem. In this area, it is important to ensure that the global standards, firstly, don't conflict with concrete steps taken in places like the EU, because otherwise you end up with exactly what you don't want, which is sort of deeper fragmentation. And then it comes back to this point around, certainly around the disclosure area, then you have a lack of comparability, which then defeats the whole purpose of the exercise. So I think the way in which I think we approach this is that different jurisdictions will produce different iterations of the way in which they expect firms to disclose, the way in which they expect asset managers to behave, and integrate the construction of taxonomies and such like. But because, in particular, climate is a global issue, the emissions footprint of the EU is a relatively minor part of the whole picture when compared with the footprint of, say, Asian electric power generation, which accounts for something like 40% of global emissions. So in order to have impact, you need to align. There's no doubt about that at all. But I'll just give you one example of where that is being done. I mentioned it earlier on, which is in the context of taxonomies. Last May, we being the SFC in Hong Kong, we convened a meeting of the chair of ESMA, Stephen Mayor, a representative from the Commission, from DG FISMA, from the People's Bank in China, and from Mary Shapiro, who's the leads work for the TCFD. And a few others, but they were the core members. And the whole point really is to say, look, Europe and China together occupy or account for around 40% of GDP. I've already mentioned, the emissions contribution, not just of China, but the rest of Asia, but China's a big lump of that. Much of the discussion, of course, is around coal. And the point of it was to say, look, China is producing a unified taxonomy. Europe is, through its technical experts group, is producing a detailed taxonomy, not without controversy, which is inevitable, but and discussion, but nevertheless, that's being done. It only really makes sense for these taxonomies to align. So the project that was then kicked off after that meeting, as between China and Europe, was to go through an exercise where there is commonality. And where they've got to, as I understand it, is that I had feared that the level of commonality between the taxonomies, because two very different economies or regions, one a regional economy and the other, you'd have thought that all of the discussions to construct taxonomies, or the discussions in each country, well, in one region, one country, would be very different, producing different outcomes as to classification. But actually, as I understand it, the differences which in the first phase would be eliminated to produce a common taxonomy weren't that great, particularly as the China taxonomy ultimately pulled out clean coal. So that's a good result, and I think that's now been taken on, as I understand it, to produce something called a common ground taxonomy that would include other taxonomy proposals globally, not just the EU and China. So that's it's hard work, but that's the sort of approach you need to take to when it's so important for, at the very least, a minimum global standard to address a global problem.
Thank you, Ashley. I know we need to move on, but there's 2 or 3 questions that came in, and maybe I kind of group them a bit together into one follow-up point. But you're absolutely right. I think it's interesting. Start with the European Investment Bank engaging with China, that there was a surprising convergence of the 2 taxonomies, and that's been taken forward. And yes, we had the Commission here 2 weeks ago talking about this idea of an international platform and the ground taxonomy. But nonetheless, how do you see the whole concept of taxonomies? Because we're now debating implementing this into European law, and they're incredibly prescriptive. And I mean, that's the challenge, that you kind of leave enough discretion and don't, prescribe the exact path of a transformation. And I think that's becoming particularly important as we're moving from disclosure, as you rightly say, in Europe at least, more and more to incentivizing investment in particular directions. And linked to this, the question which is interesting is your point about the IFRS work. One of the questions from Susanna was that actually the whole design of the IFRS is very investor driven. And how do we bring other stakeholders into this exercise, be it corporates, be it public authorities, particularly if this new non-financial reporting standard will be used much more broadly going forward?
Yeah, well, on the second one, I think it's just in IFRS. I think it's early days. I mean, they are really just ending the first part of ending a consultation period. So they're going to have to start making up their mind as to how different stakeholders do interact with a new board, if indeed that new board is set up, sustainability board. It would have to be operated on both from a technical perspective, but also, I think, on a governance perspective, differently to accounting standards, because the stakeholders and the issues it's dealing with are different. So, but that's probably all I should say at the moment on that, because I think, we're not really, and IFRS is not really in the design phase yet. So, but it's a valid point, and there's a lot of, my concern around this is that maybe IFRS may have underestimated how much effort it will take to put together a credible outcome. But in IOSCO, we're really, really keen to work towards that. And incidentally, the IFRS project does address the aspect of sustainable finance or climate finance that we are concentrating more than most, which is actually not so much taxonomies within IOSCO, but much more ground level real economy disclosure, including double materiality. But you may have noticed that the starting point for IFRS is single materiality. In other words, standards around the disclosure of financial risks, which could affect a company's performance in the future, arising from climate change, which is kind of the TCFD framework, but not so much the impact on the environment, which is a different kind of aspect as a starting point. But all that will have to need to be put together. On taxonomies, good point. I'm not going to really comment on that because in my part of the world here in Hong Kong, we're at the very, very early days of putting a taxonomy together. And yes, we know that the European approach is pretty prescriptive. But we really need to start looking at not only the content of taxonomy, and what we do hope to do is adopt a common ground taxonomy in Hong Kong. It may need to be tweaked a bit to local conditions, but also we need to work out how it is hardwired into our regulation here when it comes to, fund manager level, and corporate level and product level, So we'll look with interest as to how this pans out in Europe. I know it's controversial, and I know that some aspects of the taxonomy have been a result of negotiation, and some aspects didn't follow ultimately the work of the TEG. But there we are. I won't comment any further because I'm not directly involved in the European project.
And yes, we could spend a lot of time on it. We spend a lot of time on it, and actually it's still very controversial. But two just last comments from me. Actually, thanks that you raised the point about the double materiality. So it's early in the morning, because Philip from Share Action asked actually that question. The other point is, and I leave that as a comment, is it will be fun when we look at social taxonomies and how we align internationally on social taxonomies. Yes. I think there you will find more difficulties between, let's say, China and Europe, but I don't ask for your comment on that. Maybe I move on a little bit to the second point of our discussion, which is around, the COVID implications for capital markets. We've seen a lot of volatility. We're seeing equity prices going through the roof at the moment. I know you've been starting to you've looked at this very closely. You've worked very closely with your members on this. Congratulations, by the way. I think the international response to COVID has been remarkable, both by the prudential regulators and the central banks, but also by the conduct regulators. But maybe you would like to reflect a little bit on that, what you did, what you've seen, and how it impacts IOSCO's work program going forward.
Well, I'm bound to agree with you. I think that the global regulatory community in that crunch period in March, April, did a really, really good job in collaborating and acting very, very fast. I mean, obviously, the highlight of that was the sort of central bank interventions in corporate credit markets, basically, across, and which continues. But there was much more to it than that, because essentially we had two issues going on at the same time. The first of which, as a result of lockdown, ultimately, the first of which was kind of the sudden stop and the collapse of demand and supply across economies, that then led to the dash for cash, that then led to liquidity, an evaporation of liquidity, including liquidity in safe assets. And ultimately, the central bank intervention, we as market regulators spent a lot of time ensuring that traded markets or asset markets stayed open and functional and orderly, which by and large they did. So we avoided a financial or systemic crisis, either at a market level or at a sort of at a broader level. You're quite right to point out all of the commentary that has been made since then on the apparent disconnection between the economic news and the prospects and where markets sit. But of course, we'd already had before March 12 years of low rates. There were attempts in the latter part of that period to signal a rise in rates, and all of that sort of didn't happen before COVID. That was already at the end of last year. That was coming off the boil. I mean, the days of the taper tantrum seems like in a different era. We had obviously a a continued hunt for yield. We still had, and I think personally, this is a major topic, and I think it's such a difficult one to get your hands around. But nevertheless, we have, a set of major incentives to favor debt over equity at a corporate financing level. And we did have, in reality, although there was a sort of narrative, and there still is a narrative that, look, we went into the crisis with a banking sector by virtue of post-crisis reforms that was highly resilient and therefore was okay, and managed the crisis very well. And we had a non-bank sector that it may be seen by some not to be in such great shape structurally. The fact is that one aspect of the liquidity issue in March, which incidentally needs to be separated between money markets and other asset classes, I think, and money markets and short-term markets and other asset classes. But we went in there where incentives around for dealers to continue to provide liquidity, bank dealers in the market had declined massively over time, and we saw that dealer capacity was limited. So that was where we were, and of course, coming out of the central bank action and the fiscal stimulus to economies, we had all of the essential characteristics which had inflated markets prior to the COVID crisis increased. And not only that, but we have fragile corporate balance sheets. So investment grade leverage is the highest it's ever been since I think the late 1990s. High yield is the highest ever in volumes, and of course government debt surged as well. So we have a very different financial landscape. I mean, right now, in a nutshell, we're kind of looking at two aspects of this, one of which is much more sort of financial stability and structural, and that's a sort of deep dive with the Financial Stability Board on, March was a real live stress test of the non-bank system. This is the awful phrase, or acronym, NBFI, which is non-bank financial intermediation. That kind of replaced shadow banking, but basically it's a reference to activity outside banks, notwithstanding the fact that there are big interconnections with the banking system, so, which ranges from, the derivatives cleared markets and how margin behaved in those markets when volatility went up, right through to both money market funds and open-ended funds, and then looking at liquidity under stress and the underlying bond markets, those sort of topics. So that's one area where we are doing some pretty intensive work at the moment, with the prospect of concrete policy actions emerging towards the end of next year or into the following year. And then the other area, which is much more in kind of IOSCO's line of sight, is much more the this point around, which is not being played up as much internationally, but I think is important. And we have a group looking at this specifically, and who will be issuing a report on this, at least an interim report, is just how retail investors fared and are faring in a system which continues to be under stress, not least because we have seen, amid high market volatility, working from home, etc., we've created, there are a whole heap of new pressures, not only on retail investors whose economic situation will have deteriorated, but also pressures on financial services firms. And that can lead to quite a sort of toxic mix to do with mis-selling, mislabeling, and misleading disclosure, marketing of complex products that may be unsuitable, etc. And of course, we've seen that big uptick in online trading by retail, that of course also is a new phenomenon. So all that and what it means for the way in which regulators look at firms' risk management and we supervise this activity, I think is a different world. We've got all sorts of issues of fairness arising out of the aftermath of support given to banks to lend. And these are effectively solvency risks at a retail level. And then quite separately, in our world again, we've got still we have working from home. Actually, it was amazing. I mean, no one had really sort of stress tested what would happen if people don't go to the office in the financial services industry. And by and large, it turned out much better than you might have expected. But nevertheless, it kind of highlighted issues around reliance on technology that had been flagged beforehand, which are now very real. So just one of them is continued debate about outsourcing to technology firms or service providers, and concentration risks around that, but also regulatory risks around that, just as one. So how we move forward with this intersection between regulation and technology has really been highlighted by remote working and working from home. So I'm sorry that was a bit of a sort of canter through everything inside, but that's kind of where we're up to. Actually, the last thing I'd say is that it's very I think there's a very large amount of work being done on how did the system cope with the stress test in March and thereafter. There's a central question to which many would hope to achieve an answer, which is, having regard to those stresses, what's the right level of resilience in the financial sector across financial services, whether recognizing the interconnections between, say, the funds industry and banks, but also recognizing the special characteristics of the short-term markets where there were problems, which were associated with, markets that are close to, seen to be cash-like or safe assets. There's all that work is being done. The question that's been asked is, okay, what's the right level of resilience to limit the prospect of the need for central banks to step in future? And there's a moral hazard angle to that as well. Not that actually there was a moral hazard issue with the intervention in March, because I think the view is that no reasonable firm would have anticipated what happened and therefore have taken risks it shouldn't have done in the anticipation of central bank intervention in March. But given that central banks have intervened, then that's not the same question for the future. And they've intervened in markets where they've never intervened before, including, to an extent, high yield, to a degree directly in money market funds, etc. Anyway, so that's the big question: right level of resilience. Easy question to ask, difficult one to answer. But the question is, are we spending enough time in looking at how we need to reconfigure the way in which we approach markets in light of the probable trajectory of the recovery? So I think that's where there needs to be much more focus.
Thank you very much indeed, Ashley. I think you're right. If we had a kind of a, like the BBC does in different news outlets, the word of the year, I think the word of the year in finance is resilience, other than COVID, which is, of course, cross-sector. I think against that backdrop, you ended on money market funds and open funds, and in general, how the rush to cash in March kind of impacted things. I know you're kind of going through the process, and it's maybe too early to say anything as to the direction of travel. But I think if you speak to operators of money market funds, they would say, look, this was a unique macroeconomic environment. It doesn't really speak to the prudential framework and the liquidity arrangements that have been put in place around money market funds over the last few years. What type of actions do you kind of envisage there to break that kind of money market fund sovereign or kind of central bank nexus, so to speak? Is it all about gates? Is it about more liquidity being held by the money market funds, which in the current low interest rate environment would really be even more difficult for them to do? Yeah. What type of actions could you envisage in this space?
Yeah, well, I think in relation to, we've got to be very, very careful, because the money market fund sector is large and has grown to be important, both as a place for banks and non-financials to park cash, but also as a source of financing, of short-term financing, and then that's the linkage, obviously, to the underlying short-term markets, commercial paper, etc. So we have to tread very, very carefully. There's no doubt about that. I think, the other thing that we need to do in order to address whether or not there could be improvements, regulatory improvements at fund level. So for example, there's a pretty well-known or well-documented concern as to whether or not when you have liquidity buckets described by a percentage of assets under management, and you're heading down towards that direction in terms of your over liquidity profile, and then you're expected through regulation to look at fees and gates, does that then have a pro-cyclical effect in terms of redemptions? So it's a valid question to look at as an isolated instance. And there are other issues at fund level, I think, which are worth looking at. But I don't think you can really form any conclusions until you've looked at the whole ecosystem, which is fund level, underlying markets level, which is basically the short-term markets. And then so far as the short-term markets are concerned, you're looking at issuers, and you're also looking at dealers as well, as part of the mix. And to an extent, central banks, not necessarily as those central banks intervening to rescue, but more central banks as participants in the market in normal times. And then also you should look at investor expectations of money market funds. So what do investors who do park their cash in money market funds, how do they view them? Do they view them as effectively cash-like or cash equivalent? Do they view them as being effectively investment-like, or some gray area in between? And what does that mean? So that's I think the right approach. I personally don't think it's right to simply look at it purely at the fund level.
Thank you. Interesting. I think I want to also come back to the retail investor side. You mentioned, it's becoming more and more important to IOSCO. I think for me, that's also been one of the interesting trends, not just with COVID, but going back a bit further, that you're focusing more and more on the retail investor perspective. And you've established a specific retail market conduct task force this year to look at some of those issues. What I find interesting is the link to technology. I think technology, if you look at markets like China, companies like Alibaba and others, where individual investors have had access to the markets much quicker through disintermediation of fund managers or intermediaries. How do you see that role of technology impacting the involvement of retail investors going forward? And how do you think that impacts kind of the work that IOSCO will have to do, or its members will have to do, to manage this process, as you say, to avoid mis-selling, misbranding, misunderstandings in this area? Because I think the whole markets will blur more and more over the next few years, and the technical distinction between retail and wholesale, which has kind of been so prevalent over the last 20 years, is starting to break down.
Yeah. Actually, in a funny way, even though that it's a complex area, and I sometimes think that the comfort zone for regulators tends to be more in the wholesale world than retail, as the retail world is so fragmented and difficult to understand, but also it's incredibly important. So it's a harder nut to crack, and there's a lot of sort of politics around the retail end. Whereas the wholesale is a bit more specialist. It's a bit more. It obviously is incredibly important, but it's also where sort of regulators tend to cut their teeth and focus. And that's actually why early on in the pandemic that IOSCO decided to set up its retail market conduct task force, because it wanted to, even though there was a lot of time, quite rightly, being devoted to financial stability issues, and we have a dedicated group to that effect, which works hand in hand with the Financial Stability Board. We really wanted to emphasize retail. Now, and I've mentioned earlier on, some of the issues that have come out of the COVID crisis itself, where there are pressures on, public investors under stress, or potential investors under stress, and also on firms that service them, and how that can lead to a very sort of difficult dynamic. But I think more broadly, again, COVID has accelerated a number of conversations and just policy discussions in a number of areas. This question of technology is definitely accelerated, and there are sort of two footprint problems or remit problems. The first one is cross-border, which we really haven't cracked properly. We have lots of cross-border cooperation after the fact as enforcement agencies and memorandum of understanding and such like. Lots of it's a very, very effective. There's a very effective kind of system of cross-border assistance in enforcement to deal with issues that have harmed retail investors, amongst others. So that's right. But we still have a real problem around cross-border sales over the internet and the involvement of social media in that. And that is because even though we're now, 2020, most jurisdictions' laws and regulation are fundamentally territorial. We know where there is, extraterritoriality might apply, both, from the perspective of EU equivalence, say, or the sort of more traditional US approach to what a US person is and, the exorbitant privilege of the US dollar, et cetera. But by and large, when it comes down to conduct regulation, you end up with a territorial approach that does not sit well with the cross-border offering and sales of products that may not be suitable and often aren't to populations. And we need to try and work out how to address that. And the second dimension of remit is goes back to this question of outsourcing. So I'll give you an example, which is a China example, but it's quite a well-known one now. Only about a few weeks ago, we were on the verge in Hong Kong and Shanghai of a listing which would have been the largest ever in the world of Ant Financial. And at the very last minute, that was called off. And I won't go into the the ins and outs of that week, other than to say I think the Hong Kong financial system coped just as well with an IPO that was called off as it would have done with the largest in the world. So from a market's perspective, in terms of the confidence in how the markets handle big events, that was fine. However, if you look at the coverage of what the Chinese authorities, financial regulators, and others have been doing since then, it's essentially this, which is to say, look, Ant Financial has operated in part as a platform using big data and very granular data amidst all of that around the Chinese, the public in China, derived from its activities in order to extend microloans to a very, very large number of people or sections of the public. Those loans, however, sit on the balance sheets of traditional banks in China. And in essence, what that involves is effectively an outsourcing by those banks of their credit assessment to a third party, being Ant Financial, through which runs the algorithms, which then incorporate all of the data that lead to a different type of credit assessment. So what the regulators in China have basically said is that, well, look, that's all very well, but we think there needs to be skin in the game. And they've been talking about the retention of a proportion of the loan risk on the balance sheet of Ant Financial. Now, I'm not going to comment on whether that's good or bad, but it's a very clear indication of in China of an issue that we're looking at globally, is that where does the regulatory footprint need to sit when traditional financial services are being fragmented across different service providers because of technology. And it's absolutely crucial, I think. And then on top of that, incidentally, China is also looking at the competition aspects of that, which to a large extent is quite similar to the approach to competition and technology you can see in the latest US antitrust actions around Facebook, etc., and also in Europe. So nothing particularly unusual there, but I think these are all harbingers of future developments around regulation and tech.
Thank you very much indeed, Ashley. I'm conscious of time. It's always a pleasure speaking to you and to get that perspective from Asia. Actually, yesterday evening, the Commission published legislation here, draft legislation, to deal with platform economies and their influence. So it's kind of very timely. I think the last point I just would want to say is also a big thank you to IOSCO, I think, for your deference paper. I think that was a very remarkable and forward-looking paper to try and bring, as you mentioned, equivalence and other elements, create some global framework around that. I know it's more around the wholesale markets. Equivalence and deference in the retail markets, for all the reasons you've described, is still a fancy idea, I think, if it ever is to be a reality. But I don't know whether you want to just close on saying a few things on the deference paper, because I think obviously it came at a very interesting time, not least with the EU-UK ongoing negotiations.
Yeah, well, actually, very briefly, it was the background to that paper was that I'd led a task force a few years ago on exactly this topic. Basically, we didn't get anywhere really because the US approach was so opposed to the EU approach. One was pushing an equivalence international comity kind of narrative. The US approach was much more, if an activity or an entity falls within our jurisdiction and it's registerable, as it were, then we'll register it, and then we'll just treat it as if it was sitting in the US so that was effectively an extraterritorial approach of that type. Equivalence is a different sort of approach, more akin to deference. The change was that the CFTC, which was important in this context because the CFTC obviously is derivative markets and ground zero for equivalence and deference globally, was around clearing amongst other areas, and still is. The CFTC basically moved away from that hard line or very sort of purist approach and started embracing deference. And that was under the chairmanship of Chris Giancarlo and has been carried on under the chairmanship of Heath Tarbert. And so we just grasped the opportunity, which was, it did seem to us globally, who had no skin in the game in either Europe or the US, that the US was shifting much more to the EU approach. But because of Brexit, the EU was taking a tougher approach within the context of equivalence. But at least they'd moved further together. So that's why we thought we'd be able to describe a common ground set of best practices, which is what we produced. I have to say, given the political background or political environment, and that was produced, it wasn't straightforward by any means, including that aspect that deals with the mechanism that should be followed if it were the case that a jurisdiction that had recognized another jurisdiction decided that recognition was no longer valid because the other jurisdiction standards has moved away from, or its practices or its enforcement effort, or etc., had moved away from the basis on which deference was awarded in the first place. So, and you can see why that was important. But in other words, we got there with a best practice, including that topic of, how do you handle divergence, which I know is a is a super sensitive topic, but that's where we got to. And right now, what we're doing is we're digging into the supporting framework for deference, including the role of supervisory MOUs. Once deference has been awarded or recognition has been given, how do supervisory MOUs play a role in ensuring that there is a continued kind of dynamic relationship between recognized and recognizing jurisdictions.
Thank you, Ashley. I think, yes, that last point was really important. I think it's managing the ongoing deference process or equivalence process, and then also managing the divergence process and not having a 60-day deadline when equivalence is withdrawn without much transparency. So I think congratulations on achieving that. I did think it was quite interesting to hear the European Commission being highly complimentary about that paper days after it was published, more so than I might have anticipated. So big achievement to you on that. And by the way, we had Heath here 10 days ago reflecting exactly on the points you've said as to where the CFTC has been moving on deference. With that, I'm conscious of your time. Ashley, it's been an absolute honor and pleasure. Hopefully we can do this in person again. We would normally have seen you also in Thailand earlier in the year and might see you virtually in March in that context of the Commission's and IOSCO Asia Pac's annual meeting. But thank you very much indeed for being with us today and for really closing our series of what was 31 webinars with a real bang. So thank you very much. A Merry Christmas to you. Happy New Year when you get to it, and hopefully see you in person next year. Thanks, Ashley.
Absolutely. Thank you very much. And again, yeah, I really hope to see people in person next year. But thank you.
Thanks very much.